All right. So this is the webinar on out-of-state investing for July 21st. My name is Michael Evans. I'm the president of the BNIC network. We provide or we manage real estate deals on behalf of investors, but we only do it in the great city of Detroit because Detroit is the best cash flowing market in the United States, and it's also one of the best for future appreciation. And I'll be talking about that a little bit more. A little bit of background about me. I have a degree in economics from Loyola Marymount University with a focus on econometrics. I spent the last 30 years mainly working for the government, building complex operational and financial systems. I've managed hundreds of millions of dollars. Um, I was the chief financial officer for Santa Barbara County's mental health department for 4 years, where I managed and developed a $106 million operating budget. I was also a contract CFO with my consulting company, helped keep my money. I was a contract CFO for a nonprofit in Santa Barbara. There, they had a $7 million operating budget, but they also had an $11.5 million endowment fund. And so I will say this, as a Black man who has had the opportunity to manage more than $100 million on behalf of rich white folks, I have learned a lot of valuable lessons. Normally, as a Black man, I would come off threatening to white people. But in their environment, and after I prove myself and what I'm capable of, there's no longer the fear. And so rich white liberals will start spilling the tea, telling you everything about how they got rich and how they stay rich. And so I learned a lot of strategies. And one of the things I learned about these strategies is it normally takes a fair amount of money in order to make double-digit returns with little risk. And so keep that in mind, because in the end, we're going to be talking about how do we practice cooperative group economics, and we've implemented that through the sale of fractional shares. And we'll talk about more about that at the end. So I'm going to talk to you briefly about what out-of-state investing is, the benefits, some of the challenges. I'm not going to spend a whole lot of time on that section because I just spent like an hour and a half last week on that. And you can look at the recording, and I just got to figure out in the chat. Give me a minute, because I will put the link in the chat. There we go. So the link has, or the chat has a link to last week's webinar where you can see where I talk in depth about investing out of state. So I'm gonna focus this one a little bit more on why Detroit and why the BNIC network. So let's get started. And feel free during this time to interrupt me, stop me, ask a question. I can't see the chat, so you just have to unmute yourself and just ask a question. Okay, this is very, very informal. So we're going to focus now on becoming an out-of-state real estate investor. And so why should you become an out-of-state real estate investor? And we really focused on these four things last time. You're going to get a higher cash on cash ROI. And that's what it's all about, right? ROI and cash flow. So you're definitely going to get a higher cash on cash ROI if you are located along one of the coast states where you have high property values and you invest in the Midwest. You're definitely going to have higher cash on cash ROI. Lower cash investment. Last time I used the example that in California, the median home price is over $800,000. In Detroit, you can buy a house and rehab it, and the whole project cost is $50,000. Better money management. So if you can take that $800,000, if you happen to have that in cash, but most people would not buy a house in cash, say in California, they go get a loan. And when all is said and done, they're going to be in around $200,000 to buy that $800,000 house. So if you got $200,000, you can put your money into one property that you hope will do well. But if there's a problem, now all your eggs are in one basket. Versus take that 200,000, let's go to Detroit and let's do 4 houses. If there's a problem with one house, you still have 3 good houses. Uh-oh. I'm zooming in, huh? Pressing the wrong buttons. And you can have better risk management. So if you're serious about investing out of state, hold on, because that means a person just came in. There we go. If you're serious about investing out of state, you need to have some good systems in place. You need to have good boots on the ground. You need to have a good communication system with those boots on the ground. And you need to um, see what systems they have in place. So you got to have your system for managing your portfolio, and then you got to see the system that the boots on the ground has. So why Detroit? You will hear me say that Detroit is the best single family rental market in the United States. And I say that based on the numbers. So in May, when you look at Zillow's historical data of the median sales price by zip code and the median rent by zip code, in order to calculate what's called the rent to price ratio. It's just the monthly rent divided by the sales price. You will find nothing but Midwest cities. There's one eastern city, which is Baltimore, which is in there. But you'll see Jackson, Mississippi at the top. Okay. Detroit is number 5. But when you look at multiple zip codes in Detroit, you will see that you can consistently get higher than a 2% ratio. And for those that may be new to real estate, I suggest you go to biggerpockets.com or even Google and just look up the 1% rent to price ratio. Okay. That has been a standard of a minimum for buy and hold rentals. Well, in Detroit, we're shooting for 2% on a regular basis. And there are zip codes that allow us to do that. Again, the price point is around $50,000, but it's the sheer volume of available properties. Detroit has 70,000 vacant homes. I'm sorry, vacant lots and boarded up homes that are owned by a single legal entity called the Detroit Land Bank Authority. Now, at one time, the Detroit Land Bank Authority had 100,000 vacant lots and boarded up homes. So because of this, there are a lot of programs that the land bank has. And when you add in private parties that own vacant lots and boarded up homes, you're probably looking at about $80,000. And so it is definitely a buyer's market, but there's also the buyer beware sign, because It is Detroit is a city of hustlers. And if you don't know what you're doing, you'll get hustled and you won't even know it. So um, it's because of its great rent to price ratio and the sheer number of properties that are available at this low price point. Now, it's also one of the fastest appreciating real estate markets. In January, it was the #1 market that only beat out Miami. Um, but when you go again by zip code, and I can just tell you what my experience has been. I started looking at investing in Detroit in January of 2021. And at that time, you could buy the standard housing stock, which was 3 bedrooms, 1 bath, about 1,000 square feet in the hood. You could buy it and rehab it for $25,000 all in, and you'd be able to rent it for about $500. Still a 2% rent to price ratio. Well, that same property now is $50,000 all in, and it rents for $1,000 a month. So the value doubled in 3 years, and the rent doubled in 3 years. Now, there aren't too many markets that I know where that happened. And if you do know of that market, please let me know. Put it in the chat, send me a text. I'll be very interested in. And so Detroit's market is not going to continue to double every 3 years, but there are zip codes and neighborhoods that will definitely have double-digit appreciation for the next few years. And so you ask why? So in 2018, they basically rebuilt downtown Detroit because of President Trump's signing of the Opportunity Act, which created opportunity zones and qualified opportunity funds. And so the owner of the Cleveland Cavaliers got with the former planning director of the city and threw hundreds of millions of dollars into downtown Detroit, got properties, pennies on the dollar, and made a killing. The result, though, is a brand new downtown, brand new riverfront, and brand new sports facilities. And then after that, they played a little bit around the downtown area as far as starting to gentrify that area, because that's what the formula says. Rebuild downtown, and then workers want to live closer to downtown, and so you start gentrifying around downtown. Meanwhile, the inner city, they really didn't touch with that. They do a little bit here and a little bit there, but they're afraid of the inner city, and there have been attempts from outside investors, developers, to try to develop for the people that live in the neighborhood, but then it gets run down again. I believe, being a Black activist since 1986, a lot of it has to do with the community not feeling involved in the development, right? That an outside developer is just coming out to take advantage of them versus partnering with them and helping them, which is what we're focused to do. So having been in college in 1992 during the riots and a very active activist during that time, the inner city of Detroit is very similar to LA in the mid and late 90s. And so if anybody knows anything about Los Angeles real estate, that whole area has been gentrified now. And so we have an opportunity as people from out of state, out of Michigan, to help rebuild their Black community, help stabilize their rents, while at the same time making a double-digit return. As I say, there's enough meat on the bone for everybody to eat. So why should you work with us specifically? Well, one, we make the process simple because we manage all aspects of the real estate deal. From finding the property, we use a risk management system that I developed called the Real Estate Deal Management System to identify properties. We may scan 100 properties a day and only 1 or 2 meet our criteria. We then go through a pre-purchase due diligence process. Um, we'll through the purchasing process, we manage that. We deal with only refundable earnest money deposits. We do inspections. House has to pass inspection. House has to have a clean title. And then once we close on escrow, and we close on every house in the name of the LLC, and the LLC is just the name of the address of the property. Then it's about rehab. And so we've partnered with Great Lakes Property Management, which is a full service real estate company. They've been in business since '06. They manage more than 300 rental properties. Where we're at around $50,000 is their sweet spot. So well, the majority of their clients are out-of-state investors, but they can take you from the cradle to the grave. And so we use our system to help identify a property, make sure that the numbers will work. And then we use their services for rehabbing the property, placing a tenant in the property, because you got to place the right tenant in the property. I say that we go into C-class neighborhoods, we build B-class properties in order to attain and retain Class A tenants. We shoot for Section 8. Per the law, we can't exclude someone who is not Section 8, but that's who we build our properties for. We build to pass our Section 8 inspections on the first time. The entire process from close of escrow to acquiring a tenant is typically about 3 to 6 months. We charge a 2% fee on the purchase price, on the rehab, and then if you decide to keep it, 2% on the gross rent for the first year. And if you decide to sell it, 2% on the gross sale. We also put our money where our mouth is, because we make our money on the back end like you do. We provide a preferred rate of 10%. And so what that means is whether you are keeping the property and adding it to your portfolio, or if you are selling the property or you sell part of the equity in your company, you're going to get 100% of the profit, up to 10% of your investment. Everything over that is split 50-50. So let's talk numbers. So again, if you're a traditional investor, that means the investor who takes the most risk, who it takes the most time, 3 to 6 months. We're going to create a turnkey rental investment property on your behalf. You can be as active or as passive as you want. You can fly out to Detroit and you can look at properties if you want. Our first client is from Los Angeles. She's never invested in investment real estate, and she's never been to Detroit, and yet she trusted us. And we created a turnkey rental property for her that generates around $7,500 a year in net operating income. And she's all in a little bit more than $50,000. And the property has been humming along with no problems since we put tenant in there in November. So you're going to need $50,000 in cash or cash equivalents. Cash equivalents means that when we need the money, you're able to get it. So if you've got a line of credit, if you're using your credit cards and you're getting cash advances, we need to have that those funds accessible quick. And we also recommend a $5,000 contingency. I already explained that you keep 100% of the profit, up to 10%. Everything after that is then split 50-50. So on a typical property, you'll be all in 50,000. We'll sell the property or sell 90% of the equity in the property for around $75,000. And so 75,000 minus 50,000 is $25,000 in profit. Well, based on the preferred 10%, you're going to get the first 5,000. So you get that first 5,000, leaves 20,000 to be split between the two of us. And so you get another 10, we get 10. So in that scenario, you get 15,000, we get 10,000. So you make $15,000 on your $50,000 cash investment. That's a cash on cash ROI of 30%. And again, we're talking about a 3 to 6 month period. And again, this is if we're selling the property or selling the equity in the property. So if you can do this over a 6 month period and you basically wind up with 65,000, well, what do? You take 50,000 and you do it again. Take that 15,000 and put it to the side because you're going to continue to do this until you get enough money to buy another house from your profits. And then what you do is you do 2 houses at a time, and then 3, and then 4, and then it grows exponentially. And again, this is without leverage. This is all cash deals. And here's the beautiful thing. It's that initial $50,000. So I can show you how in about 8 to 10 years, you can grow your portfolio to about 60 properties and $1 million in cash just off an initial $50,000 investment. Now, I've talked about all the great things, right? Worst case is we build this turnkey rental property for you. It gets rented, but for whatever reason, you can't sell it and you can't sell the equity in it. So you just have to keep it and you got to earn 15% ROI per year. That's the worst case. So that's as a traditional investor. Now you could also be a retail investor. So a retail investor is a person that purchases the turnkey rental property once it's been rehabbed and once it's already generating monthly cash flow. And so a retail investor who purchases 100% of the property can earn a cap rate of 10% if they're a member of one of our investment clubs. So, right? So we give them first dibs, we give them an incentive to move quickly to buy the entire property so that we can sell it at 75,000 and then you can get your 15,000 and then we can start repeating this. If we're not able to sell it to someone in our that's a member of our investment club, then we sell it for a cap rate of 9%. That 9% cap rate now pushes the price up to around $84,000. If you're in Southern California, you're used to getting a 4 or 5% cap rate. So 9 and 10% cap rates are very attractive to you. Now, we also have it to where retail investors can purchase part of the property. It's actually part of the LLC that owns the property. And they can earn a cap rate or an annual ROI of over 8%. And the beautiful thing is the minimum investment amount is $500. And then they just go up in $100 increments. This is a great way for a person to get started. And what it does is it gives you some cash flow because we pay out payments quarterly, right? What happens is every quarter we do our books. We've set aside money into our reserves. We've paid the insurance. We paid the property taxes. What's left is the profit. And so we divvy up the profit proportionately to all the owners, okay? So you're basically going to get a little bit more than 2% every quarter. And our intention is to sell properties after a 2-year period. And we sell it at a lower cap rate, which is a higher price. So if you have a property and it's been performing, generating income for the last 2 years, we're going to price that at a 7% cap rate. At a 7% cap rate, $7,500 a year in net operating income, that's a little bit over $100,000. And so there are investors from the Middle East that are coming and spending millions of dollars to buy turnkey rental properties, and they're satisfied with the 7% cap rate. Again, in Los Angeles, you're looking for a 4 or 5% cap rate, right? And that's for you to buy something and hope that it performs versus buying a property that's already been performing for a couple of years. The risk is very negligible because the value of the property really can't go down, and the rent's not going to go down because we're renting to Class C and D um, tenants. So, well, so what happens is when we sell the property, you get a portion of the profit after profit split. So at $100,000, you would make another 25%. So if you held on to the property for 2 years, 8.5% the first year, 8.5% the second year, 25% on the back end, you just made 43% on your investment, right? So that's more than 20% a year. And you were 100% passive because when you buy into the equity, you are a limited partner. So you don't have any voting rights. You're just along for the ride. But where else can you invest as little as $500 and make over a 20% average ROI over a 2-year period? So this is where we practice cooperative group economics. If you don't have the $50,000 to be a traditional investor, if you don't have the $75,000 or the $84,000 to buy a property outright after it's been performing, hey, we're going to put your money together with other people's money, and we're going to basically reimburse the traditional investor for their effort so that they can go and do it again and keep doing it. So that is the presentation that I had specifically about investing in Detroit and out of state investing. Questions? Let's open it up. Let's have a discussion. I see there's two of us. Melissa Dunlap, how are you doing? Can you hear me?
Okay, yes. I'm sorry, I couldn't get to the mute. It's Valisa.
Melissa, so what do you think about investing out of state?
Um, I think I think it is a good option. I am looking to invest soon. I'm in Georgia, by the way. I'm currently in Atlanta. I saw your post in the gathering spot, so I said, well, let me just see what he's talking about. So I'm looking to get in real estate very soon with a partner. Him being a silent investor, and I basically will be, I guess I guess that's what you would call retail investor. So my name will be on the property. So we're just looking to do real estate um initial I'm sorry, we're looking to do residential single family home
Mm-hmm.
at least 20 in the beginning. And I don't know if you heard of a town called Cordell, Georgia, but that's where I'm from. And eventually branch out into multi-family homes and assisted living. So yes, I'm also looking at Pennsylvania as well. So yes, I just I didn't know Detroit had so much um growth potential. I knew I had um two roommates from college. They were from Detroit and they were telling me, "Oh, Detroit is on the move. Detroit is coming up." But now that you go over the numbers, I'm seeing that it's a I think it could be a lucrative investment.
Yeah, and so what I've done is looked at all of the numbers across the entire country
Uh-huh.
and did statistical analysis as well as risk management analysis. And so I can tell you right now, there is no better single family rental market than Detroit in the hood,
Hmm.
right? They don't have enough Section 8 housing. And and again, the cost is relatively cheap to buy a property and to rehab it to a Section 8 standard. We're talking about $50,000. Um, and so the numbers kind of speak for themselves.
Hmm.
Um, and in fact, um, I do want to share one more thing,
Hmm.
which is um, the property that we're currently um, selling part of. This is 17917 McKay Street, and the LLC is named after it. Um, this
Hmm.
was our first property. We had the client out of Los Angeles. Again, she never had invested in real estate outside of her primary house. She'd never been to Detroit, but she trusted us, and she bought it in March of 2023. We had signed the contract with the Detroit Housing Authority to make it effective in November of 2023. So for her, let's see, it was about 7 months because she did it at the very end of March, and it was in the middle of November. And but that thing has been just generating cash. And what happens is Detroit Housing Authority sends a direct deposit to Great Lakes Property Management on the first of
Hmm.
each month. Great Lake takes 10 days to reconcile their books, make sure they didn't um, have any maintenance calls or anything like that that they need to get reimbursed for. They take their 10% off the top, and on the 11th of the month, there's a direct deposit that goes into this company's bank account. And
Hmm.
it's like clockwork. And so um, this is unique as far as being able to take multiple people and being able to own part of a single family property. And this is a single family property. Um, and this is a picture afterwards, but you'd have to go to this page, and I'll actually put this link in the chat. Um, but this is where we are selling units of what they call limited membership units because these are silent partners. Uh, and we're doing it through an SEC approved um, crowdfunding capital raise. And this is a Black owned crowdfunding website called Secure Living. Um, and it's a family run business by a young couple, and they do nothing but real estate projects. And so when you go here, this is you'll see it, the general overview. You can log in to invest. We've raised 41.5% of our target, which is when it closes 75,000. Again, we're selling membership interest, expected to be invested for 2 years. Cash return is 7 to 9% per year, paid out quarterly, and the exit strategy is for us to sell the property. I'm not going to go through all of this, but when you come to this page, we have two documents. So one is just the pitch deck, but the important one is the Form C. So the Form C is a form that we fill out for the SEC. And the SEC reviews it, and the SEC has to approve it before they allow us to raise any money. And so that Form C tells you about all the risks associated with investing. And it tells you all the background about this company. Um, and so, yeah, I would say at a minimum, just come and just look and see what we're talking about. Pam is the first client. She's the one who is in LA and bought the property. Um, and I'm the attorney in fact through my company. My company is the attorney in fact. We have limited power of attorney over Pam's LLC because again, we manage the real estate deal on her behalf. This just talks about how investing works, all the disclosures. Um, and so, yeah, it's a good way to get started. If you don't have any experience, if you don't have a lot of money, if you don't want to risk a lot. So any questions regarding the McKay property? Delisa?
I want to know because you said just want to know. Can you give me the numbers of how much would a investor look to receive quarterly if he's paid out quarterly? How much
Yeah.
would a mhm.
So it's right now we're running at an 8.5% return for limited partners. So what that means is if you invest $1,000, you're going to get $85 a year. And that's going to be divided into four quarterly payments. So that's like what, $21 a quarter off $1,000 investment. If you do it off of a $10,000 investment, for example, let's see, $10,000 investment, you're going to make $850 a year. So that'll be $212. The thing is, regardless of the dollar amount that you invest, the ROI is the same for everybody. And that's one of the things I'm trying to teach is for people to focus on the ROI rather than just the absolute dollar amount. You do want to look at both, but the ROI and being able to get double-digit ROIs on an annual basis is how you grow your money. And reinvesting your profit is how you grow your money and how you obtain portfolios. Did that answer your question?
Yes, it did. I think my phone cut out a little bit at the beginning, but I did catch the as far as how numbers work. What I'll do is I'll go through the website and I'll look through it, the one you put in the chat. I'll look more in detail, and if I like what I see, I'll tell my investor. Maybe we can JV on this.
Yeah, and again, a lot of it has to do with your risk tolerance. Of course, the traditional investor makes the most money, but it also takes them time, 3 to 6 months, right? And they're the ones who are putting their money at risk initially. But once the turnkey rental property is created and it's generating monthly revenue, the retail investor just comes in and either buys the whole LLC and then the next month receives a check, or buys part of the LLC and the next quarter gets a check. And the way that we prefer to sell our properties is to sell the LLC. It is much quicker. There's no escrow involved. It's simply the buyer doing their due diligence. And we have everything that we've ever done to that property since we closed electronically. So all we do is zip up all the files, all the pictures, all the invoices, everything that we've done, and we shoot it over. And however long it takes that person to do their due diligence, it can take a couple of hours, a couple of days, a couple of weeks, however their due diligence process is. But we'll have the inspection report in there. We'll have the work that's been done, the whole 9 yards. And the benefit to the buyer is when they buy the LLC, there is no change of ownership that's recorded anywhere publicly. Okay. So as far as the county knows, this the LLC still owns the property. As far as Section 8 goes, the LLC still owns the property. As far as the tenant and the property management company, all those contracts stay in place. Nothing changes, which means the tax base doesn't change, right? We are normally buying these properties between $10,000 to $30,000. Well, if we sell one for 75,000 and you go through the normal process of escrow and recording that, now the tax base just jumped from 30,000 to 75,000, which means in a year or two, your property tax is going to jump up also. By keeping it in the LLC, keep your property tax low. That's just another strategy. So, Elisa, any other questions you may have? Elisa, you still there? Ah, okay. Wow, she got a call from her investor. Well, we'll definitely connect soon. Um, and what I'm going to do is I'm going to put, yeah, I guess they'll be able to see the chat in the recording. Let's see. I want to put the link in case anybody wants to do a meeting with me. Um, there's the website address. And I want to thank the couple of people who did attend, but this was really a follow-up to last week's webinar session. And the link for that is also in here. And I'll just put it again. The first webinar with video. But we will be having these webinars on a weekly basis, according to how many people are here, what their experience level is. Each webinar will definitely be different, but we'll be talking about out-of-state investing. We'll be talking about investing in Detroit and why to use the BNIC network. And that is the end of our webinar.